In this video clip, I'm going to look at the BCVR entries for a trademark which was not recorded in the accounting records of the subsidiary, but from the group perspective, the parent company placed a value of $20,000 on that intangible. It was assumed to have a 4-year life, so therefore our annual amortization expense is $5,000. Amortization being the equivalent of the depreciation expense, but because this is an intangible asset, the reference that we use is amortization. The shares of the subsidiary were acquired on the 1st of July 2012, and we have to prepare the consolidation worksheet entries for 30 June 2016. So you can see that's 4 years down the line, which effectively means that this trademark has now been fully depreciated. But in this video clip, I'm going to look at the respective consolidation worksheet entries since the acquisition date up to the consolidation worksheet entries for 2016. So let's quickly just jot it down on a timeline. So this is the 1st of July 2012 when the shares were acquired. The trademark had a fair value of $20,000 for which we have to make a fair value adjustment. Over 4 years, it means that, so this is then 2013, 2014, 2015 and 2016. So this is year 1, year 2, year 3, year 4. The amortization expense for this year will then be over 4 years will be $5,000. 5,000, 5,000 and 5,000. Because we do tax effect accounting, the BCVR entry will be after tax, and we will create a deferred tax liability at 30%, $6. So the trademark is going to be increased by $20,000, going to create a deferred tax liability, and we're going to create a BCVR item of the balance, $14,000, which is basically a revaluation reserve that we create on group level. The amortization is annually $5,000, so the tax effect on that every year will be $1,500. So basically this deferred tax liability will be reversed annually by $1,500 over the 4 years, every year, until when the trademark has been fully depreciated and the full deferred tax liability reversed. So let's look at the first journal entries that if we had to prepare consolidated financial statements on acquisition date, and the only entries would have been with regards to the trademark is the actual revaluation. So our entry would have been debit our trademark asset with the $20,000 fair value adjustment, then credit our deferred tax liability to create that liability of $6,000, and credit our BCVR, our revaluation reserve, with the after-tax amount, $14,000. At the end of year 1, we will record the following entries in our consolidation worksheet. First of all, the revaluation of the trademark. So because the trademark is not recognized as an asset in the subsidiaries account, from the group perspective, we have to create that asset at the fair value of $20,000. We provide for the tax effect on that, and we raise the revaluation reserve, the BCVR. But because of the adjustment to the value of the trademark, so the trademark being carried at a value from the group perspective, we have to provide for the extra amortization cost on group level, which is not automatically flowing through from the subsidiaries accounting records. So we already saw that the trademarks is written off over 4 years. So our amortization expense for a year is $5,000. We record that against the accumulated amortization account, and as we amortize that asset, we start to reverse the deferred tax liability as we consume the asset. So that's the 1,500 adjustment against the deferred tax liability. In year 2, we will once again do the the initial recording of the trademark and the revaluation reserve. We once again provide for the amortization of year 2, but because these notional entries are only passed on group level and not in the accounting records of the companies, we have to also include in our consolidation worksheet entries the transaction since acquisition date that is still relevant. So with regards to the amortization, we have to include both the amortization expense for the current year, so in this case year 2, but also for year 1. And for year 1, the adjustment will be against our retained earnings opening balance, because it affected our profit and loss in the previous year. So that is to an amount of 5,000. And our total adjustment against accumulated amortization will be 10,000. So our deferred tax liability and income tax expense reversal entry will be the same accounts, but our this one will now be for 2 years and not only 1 year. So for 2 years it would be $3,000 against a reversal against our liability. We'll credit our income tax expense for the adjustment for year 2, so relating to that leg, and then for year 1, the previous year, we will adjust our retained earnings opening balance because it affected our profit figure for the previous financial year of 1,500. So if I just copy that on a new slide, it will look like this. Okay, so these are the consolidation worksheet entries for year 2 with regards to the trademark. Let's look at what the entries would look at like for year 3. For year 3, we would have the valuation entry again to create the trademark or to record the trademark in the group financial statements. Our amortization expense for year 3, which would be $5,000. Then our adjustment against our retained earnings opening balance need to be for both year 1 and year 2. So that would be an amount of 10,000, and that would bring our total accumulated amortization adjustment up to 15,000. Deferred tax liability will be raised with the tax effect of the amortization over 3 years. Our income tax expense for the current year would be 1,500, and adjustments against the opening balance of retained earnings for the income tax expense of year 1 and 2 would then be $3,000. At the end of year 4, the trademark has now been fully depreciated. In the subsidiary's financial statements, there will not be a trademark or the related accumulated amortization account, because if the subsidiary did record it, it would have been derecognized, but also the fact that the subsidiary has actually not recorded this. And from a group perspective, because it's fully depreciated, we're not going to recognize that asset and the accumulated amortization against it. However, the following entries still need to be passed for the current year. Is the current year amortization, because there's one more amortization expense that we need to recognize. Then the amortization for expense for years 1 to 3, so the previous financial period since acquisition date, but this will be adjusted, of course, against retained earnings opening balance. And then the tax effect of these entries. So the income tax expense entry for the current year, as well as the adjustments again, retained earning opening balance for year 1 to 3. And then lastly, instead of recording a BCVR revaluation reserve, that will now be transferred to retained earnings as the asset is now fully consumed. So let's see how this will be recorded in our consolidation worksheet. For the current year's amortization, we'll say debit amortization, the $5,000. Then the income tax expense on that, let's deal with that one now as credit income tax expense. So that is $1,500. That's for the current year, so year 4. Okay, then the amortization for years 1 to 3, so that is $5,000 for 3 years. It's $15,000. The adjustment being made against opening retained earnings to illustrate the effect that it affected profit in previous periods, as well as the income tax effect of that, once again adjusted against retained earnings opening balance. So that is an adjustment of $4,500. So the net effect of that is an adjustment against opening retained earnings of $10,500. A debit retained earnings opening balance, so that is for year 1 to year 3. The amortization after tax being $10,500. The last part to that entry is then instead of creating the BCVR, is to transfer it now from BCVR to retained earnings. BCVR that we've calculated initially of 14,000. So this is just a neater version of that entry. So here you can see the amortization expense for year 4 of $5,000 and the relating income tax expense entry to reverse the deferred tax liability that still existed with that as a result of that fair value adjustment. Then the adjustment against opening retained earnings, so that is for years 1 to 3, the after tax amortization for the 3 years, because both the amortization expense and the income tax expense affects the retained earnings figures or the earnings figures. So we use both or include the effect of both. Then the last part to that entry is the transfer from the BCVR, and even though it's got a long description, it effectively adjusts the retained earnings at acquisition balance. So therefore we'll see a corresponding entry in our pre-acquisition equity entries with regards to the equity of the subsidiary on acquisition date. A further entry that's then only needed when an asset is derecognized is with regards to the pre-acquisition equity adjustment entry. And this is the entry where we eliminate the equity of the subsidiary against the investment in the subsidiary that was recorded in the parent company's accounts. So when an asset has been derecognized, we'll see in the current year an adjustment to record the transfer from the BCVR to retained earnings. So effectively we would see an entry transfer from BCVR for the 14,000. So that's a debit, credit the BCVR account with 14,000. And if you look at this journal entry here, so this is not part of the BCVR adjusting entries, but with regards to the pre-acquisition equity entries, we say that when you transfer or derecognize an asset, you transfer the BCVR from BCVR to retained earnings, which is not what this journal appears to be doing. But remember, these adjustments need to be viewed in relation to this pre-acquisition equity adjusting entry. So when we transfer from BCVR, it's basically a debit to retained earnings, opening balance, and that's going to increase in the following year this balance, and the credit to the BCVR is for the following year going to be a reduction against the value used for BCVR in this pre-acquisition equity entry. So by crediting it in this adjusting entry year, we're going to reduce the BCVR balance in our consolidated financial statements. Now that's quite a mouthful, but the aim of this video clip was to show you how to get to this entry, but first of all ensuring that you understand the adjusting entries that are made prior to this financial year, because they build on to each other.